Welcome to the Midweek Market Update, where I do a technical analysis and give you my thoughts on SPY the Qs and IWM. After that, we will be taking a brief tour through our core list of companies, and if you stick with me towards the end of the video, I've got 3 additional trade ideas to share with you, so definitely stay tuned for that. Let's kick off today's S&P analysis as we always do with our sectors. Who was leading, who was losing, and where was the weight? The XLY for consumer discretionary led the pack today, up 2.81%, and as we know, this is a heavier weighted sector and more of a risk-on indication. At the bottom of the barrel, we see the XLE for energy finally giving up a little bit of its relentless rally to the upside, down to the tune of negative 2.21% on today's session. And as we know, this is about the opposite of the XLY. It's a really lightweight sector, and it's more of a defensive and risk-off indication, so interesting to start to see the skew in the sectors and the distribution here favoring more of a risk-on look, but I think that's a little bit of a surface-level interpretation, as we'll see in just a moment when we get to the actual structure of those charts. The heavier weighted sectors, the XLK for the tech sector is the heaviest of them all, up to the tune of 2.11% on today's session. XLF, second heaviest weighted sector that we're watching, up 1.12% on today's session. XLV, healthcare, third heaviest weight that we're watching, but yes, by market cap, technically the second heaviest weighted, up 1.01% on the day's session. Overall, again, at surface glance, this column right here would certainly indicate more of a risk-on look in the marketplace, but let's dive right into structure now and start to uncover, pull back the curtain, if you will, just a little bit what's really going on here. I think it's a little deceiving as of right now. So, in the XLY for consumer discretionary, although it was up the most on a percentage basis on today's session, notice the structure here, right? We have really equal and visual lows here. We call that a mechanical low, down at 136.33. If that were to be retested here off of a lower high, that certainly, in my estimation, should lead to a breakdown, which is obviously bearish drag for the S&P 500. Now, you might be saying, well, yeah, but look at the double bottom that's starting to form, something that would look like this. Well, you're not wrong in seeing that as a double bottom. Look at your neckline. It's up here, right? So the double bottom doesn't technically trigger, successfully at least, until we quote-unquote take out the neckline and prove that we're getting a higher high above this, right? So that's really not in play from a structural perspective just yet. And everything to me in the short term would indicate that the buyers didn't even really do their job today on the day's session, right? If we just take a quick glance here at how we've technically interacted with this gap overhead, notice that we have a partial gap fill. We did not technically close the gap all the way. We missed by just a little bit. If the buyers were technically strong, and this was a glaring risk-on day like it would have seemed based on the percentage distribution, then why did this not fill the gap all the way and even get some acceptance inside the range from right here? Instead, the buyers did not quote-unquote do their job, and we've rolled over into the close. There was not really high and tight consolidation into the close, the bell there, and we've closed kind of right on the beginning of the gap. So just not overly impressed with the action here. And again, I think this is just too surface level to make any claims that risk on is coming back into play here. So I'm really scouting this for a little bit of a dead cat bounce, a rollover, and then some sort of breakdown of that 136 level. Could this turn into more? Yeah, it could, and it could start to signal more of a risk-on indication for the marketplace, but let it prove it to us first. We've only seen just one day of upward action here off of the 100% retracement. If you remember what we discussed in the Sunday video, right? Many things were coming in or looking like they could come in for a 100% retracement, and usually it's very rare that you just get immediate follow-through underneath the level on the first test. You likely get a dead cat bounce if it forms an H pattern, equal low reattempt in short proximity of time after a lower high. That's where the breakdown comes from, right? So really scouting this as a lower high dead cat bounce inside of XLY, not a more meaningful reversal. This is really going to kind of ring true as a theme as we move through all of the sectors here. Let's continue along. We'll spend more time on the heavier weighted sectors, kind of breeze through the lighter weighted sectors. Real estate, really lightweight sector, but just want to take a brief pause on this one for a second, indicating that I think the market kind of priced in, obviously, the fact that we got the 75 basis point rate hike from the Fed today. And the reason I say that is because notice that we go sideways here on the official announcement that it's in place, and the big gap down took place over the weekend, right on, into the opening bell on Monday morning. So the 75 basis point was priced in. The housing market probably should have responded in a more strong way if it didn't know that we were going to get the 0.75 and instead was under the assumption that we were going to get the 50 basis point, right? So this is just one of those sort of things that you can interpret and say, okay, the market kind of knew what was going on here for the announcement on today's session. That's all I kind of wanted to read into here. In terms of its implications for the S&P 500, again, no acceptance into the gap overhead. Being such a lightweight sector, even if it did rally and do something like this, it's not going to be a huge help to the S&Ps finding a more firm bottom. Will it help? Yeah, a little bit, but not a make or break. Next up, we've got the XLC for communications. What's happening in this one? Again, the structure here is completely, in my estimation, telling the story, not so much the percentage gains that we saw on today's session. So we have this double bottom from in the past. Remember that failed. We are underneath the double bottom sort of support here. And to me, it looks more like a break retest and setting up for something that does this. Just like in the XLY for consumer discretionary, there was virtually zero acceptance into the gap overhead. So a partial gap fill, and we closed off of that level instead of in the gap, which would have been a more bullish implication. So currently, not thrilled with the structure happening here either. Just like I sort of outlined, break retest sort of sets up the move for lower, right? Just a little bit of a dead cat bounce as of right now. For me to start becoming a little bit more confident in what the XLC and communications are doing, it would require continuation higher and a higher low above that 5650 coming from the prior double bottom support in here, and also filling the gap and confirming that we don't want to move back underneath it after it has filled, right? So really scouting for that higher low before we start to flip the switch in our brains to saying, okay, back to risk on sort of mode. Remember that in here, we have the equal low, and then we had the break of the neckline, which was the bullish implication. Now, structure has been completely obliterated over the past couple of days, especially with the gap down on Monday, right? So what we have here is a big lower low underneath this area here. Remember that this can even rally, and there's still a high likelihood that we put in a lower high as long as we're underneath 61. So it really requires scouting that higher low pullback before we start to switch our brains again back into more of a risk on indication. Next up, we've got the XLK. What's going on here? Perhaps one of the more important charts to be looking at because it's the heaviest weighted sector of them all for the S&P 500. Let me make it a little bit easier to see here. There we go. Just like we've been discussing so far, we have the lower low. So we can afford a lower high dead cat bounce at this point in time. We filled the gap. This one, much more of a full gap fill than what we've seen in the communications and consumer discretionary sector. But look at the pullback that took place here. It's not like we consolidated high and tight. And, overall, not thrilled with the daily bar that has printed here. It's really more indecisive than a bullish candle. So yes, we did see a pretty decent rally on FOMC today, but none of that was sustained into the close, which is really what matters here. As long as we're above 127.15, I would carry that forward as an important level simply because it was the breakout point as well. Remember that was the Tuesday high, the inside bar sort of setup. So if we're above that, fine, more neutral to maybe slightly bullish for continuation. But if we get back down underneath that, look out below, right? This is a poor low here around 124.80s. I would expect that to break if we get something that does this, lower high, equal low reattempt. Again, that looks like a weak level to me, 124.88. So carry that forward. Obviously not inspiring the most confidence here inside of the XLK, which again is the most meaningful sector for the S&P 500. Next up, XLF, what's happening here in financials? Taking a quick look, and again, I'll just adjust this so it's a little bit easier to see. Really not impressed with any of the action that took place here, right? As we get raising rates, generally speaking, the XLF hits a breaking point where, although yes, higher rates are good for financial institutions, there's just less incentive to borrow money, right, from consumers. So that's obviously taking place here. Even with the 75 basis point hike, financials going absolutely nowhere on today's session. So more of a 3-day balance here. This strikes me as bearish acceptance underneath, again, the lows of the prior double bottom, which has now been a failed reversal pattern, right? So this certainly is not helping. And again, a little deceiving on today's session, right? Technically up 1.12%, not really doing anything impressive though, right? So it's really worth it to take a deep dive through some of these structural charts as you're sort of doing your analysis here. To me, it looks like there's still a possibility for a break retest lower or just bear flag right out of the gate, something that continues to consolidate here, looking for lower after this price acceptance at the lower levels underneath the area of support, right? Really nothing impressive happening here. Again, to get bullish, just like we discussed in the XLK and the XLC, would require taking out the highs and scouting for that first higher low to then start to shift the tone here. Obviously, there's still a very high probability with the lower low from here, there to here, that this can kind of remain in effect as a lower high. Even if we fill this gap here and roll over, the downtrend remains in place because of this darned little lower low right here. So keep that in mind as we continue to trade in the short term. Next up, XLV. This is probably the last one we'll spend a considerable amount of time on because it's the third heaviest weighted sector that we're watching, second by market cap. Really important to note here, we've fallen out of a multi-month balance at this point in time, underneath 125, right? That was the number. Monday's gap down sort of solidified that. Again, no sort of major rally on today's session that closed meaningfully inside of this gap or even came for a back test of 125. So this chart is very concerning in terms of the look here. We can actually remove that support trend line. It's obviously not doing us a whole lot of good anymore. So this chart not inspiring any confidence whatsoever that a more meaningful bottom is sort of of here or close in the near term in the S&P 500. This chart looks horrendous, to be honest with you, underneath that multi-month balance. And again, even if we do get upward lift, I would be scouting for the lower high or rejection off of 125. To flip the script back to being bullish, it's got to form a higher low above that level, and there's obviously a lot of work to be done before that would turn out to be a likely scenario. So up next, and moving through them a little bit quicker here, XLI, really lightweight sector, just consolidation and price acceptance at the lows. The downtrend continues with a new lower low. Again, even if we come up and fill all of these gaps and roll over, downtrend still in effect, and that upward lift, if it were to happen, if this were to do something like this and fill the gap up here towards 93.50, because it's such a lightweight sector, it's not going to do a whole lot to drag your S&Ps higher. Next up, we've got utilities. What's happening here? Really interesting look, just based on the fact that if we take out the trendline tool, there we go, we're kind of sitting right at the uptrend, right? And what's not the greatest sign about this is the fact that we're coming off of a lower high into the support trendline. Usually you like to buy trend lines on the higher high, pull back, right? But we've fallen off of a cliff to get here. So I wouldn't be surprised if there's a little bit of a dead cat bounce. We're already kind of stalling out here inside of utilities. Notice that on today's session, just a completely indecisive bar inside the prior day's range. It's not really doing anything too impressive. Remembering that this is a risk-off sector, it's fine because obviously it's not making new all-time highs here and leading the charge to the upside, but we don't want to see it in the gutter as well. So would love to see this kind of go sideways and maybe get a little bit of lift inside of utilities. XLP for consumer staples, again, new lower low, can't afford any sort of lower high dead cat bounce here. I would continue to monitor the 7160 level, and then after that, probably the low end of this balance around 73. So I will go ahead and pop that on the chart. So any lower highs that happen underneath 73, to me, just obvious continuation of the downtrend, right? So here's your 100% retracement, dead cat bounce, kind of equal low reattempt. Chart is kind of poised to go lower here from a structural perspective. Again, nothing impressive has happened, even though we had a fairly mild up day technically from a percentage standpoint. XLB for materials, kind of trying to find some support underneath the bottom end of the range. The reason I say that more meaningfully than other charts that we've seen so far today is just because of the size of the lower wick here. It would strike me that we took out the lows, kind of cleaned up any stops that were kind of sitting down there, picked up the liquidity, and closed back within the prior day's range. Again, such a lightweight sector, even if this does want to come up and fill the gap overhead or even come up and do this one up here, up towards that 84. Unfortunately, again, it's just so lightweight in terms of sector weighting, it's not going to do a whole lot for our S&Ps as a whole. So the best setup in terms of a bottom here potentially with this hammer that's formed in the lightest weight sector. Unfortunate, but it's just the way the cards fell. Next up, we've got the XLE finally giving up a little bit of its rally here. However, I would just encourage you to keep in mind trend analysis, right? Go back to the basics here. Do we have higher highs, higher lows? Yes, right? If you look at your 50 SMA, it's really been acting as the sort of pullback point. So here's kind of number one, number two, not quite number three, but you get the gist, right? Number 4, 5, 6, finally pulling back into the support trend line. And I'm not saying here, please don't misconstrue what I'm saying, that this is just a reason to go long energy, that we could go higher. But from a pattern perspective and what's been repeating, we do technically have a pullback into an area of support based on a trend that we've been following for some time. That would make sense where this could resolve higher. Now, the structure based on the candles isn't the greatest. Sure, we do have a little bit of a lower wick here, but we did not close back inside of the prior day's range is the main takeaway from this red hammer that has formed. And we are also underneath where this sort of most recent rally has stemmed from, underneath this big gap down as well. So, from a structural perspective, the uptrend's still intact. Don't get me wrong, but would I just go out there and buy it? Probably not. This to me is just more of a risk-off indication, noting that, again, we do not yet have a lower low and we do not yet have a lower high. If we bounce and do something like this and then roll over, fine. The start of a trend reversal is there with a lower high, but it would require taking out wherever we bounce from. Okay, so XLE still indicating risk off based on it being in an uptrend. So that's been an in-depth analysis of our sectors as we're sort of trying to navigate these turbulent times, right? Taking a quick peek at our ratio grid. If you don't know how to set this up, I've got a video for you. Top right-hand corner sort of describes and walks through what it is, kind of how to set it up as well. Nonetheless, XLK, notice that it remains in the descending triangle. We are still underneath that downward sloping 50 SMA. That's the gold line here. Not really showing any major signs of improvement just yet. Although, again, we had a fairly convincing day on a percentage basis. Nothing major has happened. That's why, again, I really wanted to walk through that structure and a little bit of deception, I suppose we could call it, going on from a percentage read basis. Nonetheless, continuing along through the sectors in the top 4 grid, XLV for healthcare, interesting look coming into a lower high reattempt of the 50 SMA. That's where a breakdown can happen. And again, remembering that this has fallen underneath the low end of the monthly balance, I wouldn't be surprised to see this kind of go sideways here or maybe top out. It's really, really kind of a stretch. I don't want you to think that I'm believing this is a major pattern here, but maybe possibility for some sort of head and shoulders, right? Something that would look like this, just sort of indicating that there's more possibility that XLV falls into risk off, and falls out of this nice uptrend in the ratio grid, which is obviously a bearish implication for the S&P 500 overall. Continuing along through the top four, you can still see a decent amount of meaningful distance between the XLY and its descending 50 SMA, bearish implication obviously, and the XLF right back down at its lows after a lower high here. We know that that structural chart as well has kind of suffered some major blows. So we don't have anything in the top four that's really telling us, hey, risk on is kind of back to the look. And again, a little bit of deception if you were just looking at a market minder window on today's session. Down at the bottom here, the bottom four are risk off sectors, and notice how these kind of still look just fine, right? Mild pullback in energy, still well above an upward sloping 50 SMA. Utilities kind of just going sideways, but still 50 SMA is sloping to the upside. Real estate, same deal. Underneath it though, but again, is one of four enough to sort of start the risk off transition here? Not really, right? Not really. And the same thing with the XLP, getting back above, kind of sideways on today's session, but back above an upward sloping 50 SMA. So I would say risk off is still the current look based on everything we've seen structurally and in this ratio grid right here. Let's take a quick peek now at our TNX for the 10-year rate, and this has obviously exploded to the upside. Again, another reason why you can sort of infer that the 75 basis points was priced in is because this moved higher and did nothing on the official release of today's sort of news announcement from the Fed. So a couple of things based on the Fed. The Fed does not believe that they are, going to trigger a recession based on their rate hikes, and I would sort of argue that it's probably likely we're already in a recession, right? And also, it's not likely that we are going to continue to get 75 basis point rate hikes going forward. Jerome Powell made it very clear in his press conference that this was really just based on the incredibly hot CPI read that came out last Friday, right? So they had to make a last-minute decision to sort of beef up what they were planning on doing, and they do not, as of right now, have this as a continued plan into the remainder of the year. Now, could something come out with CPI in the next couple of months here that would indicate that they need to do something like this again? Absolutely, absolutely. So be on the lookout for that as we move forward, and obviously the market wouldn't like that, but the fact that he vocalized that in his press conference, again, the market did sort of like, which is why it rallied towards the close, and then it sort of came in a little bit, which we'll get to in just a moment here. So TNX overall still putting a lot of downward pressure on the tech sector overall because it's hanging out, higher, obviously, as opposed to going sideways in this neutral kind of range where we wanted to see it contained, even underneath 3, right? So obviously that's not the case anymore. This moving higher puts downward pressure on the XLK, which is obviously downward pressure for our S&P 500. That's the TNX. Let's take a quick peek at the VIX. What's happening with volatility? Zooming in here, fell off of a cliff inside of VIX, but let me just quickly remind you, we are still in this box. This is a wicked box of volatility. We did not come into sort of that capitulation bottom 40 handle here on the big gap down on Monday's session, although we did gap up, right? We did not come into that historic sort of 40 monument, and now we're just kind of back in the midpoint of this overall range. So volatility is still out there, guys. Even though we had some consolidation and a bit of a rally again on today's session, it did not send the rally didn't put VIX down around 2050, so I would not be yet convinced that this is any sort of meaningful bottom, right? That's all I'm getting at here with the VIX. And even if we take a look at the VVIX, note that this has started to normalize here. Remember that this did get back up and over our 103 sort of floor from in the past, which again is an indication that people recognize that there's more risk on the horizon here, and they're starting to hedge with VIX calls, right? So that's what we have in our VVIX back above that 103. Let's continue along and get on over to the SPY itself, start talking about tradable levels into the remainder of the week. Just like we discussed with everything in the sectors so far, let me actually adjust this again. It's a little easier when it's kind of in the middle of the screen, I believe. So there we go. That's a little bit better. Just like we discussed in the sectors, again, we moved into the gap a little bit here, but there was hardly any acceptance into that overhead gap. That strikes me as a pretty bearish implication. Again, the buyers did not quote unquote do their job, and we closed weak back down inside of the sort of balance from earlier on in the week where the damage was done on the big gap down from Monday. Now, we are sitting still right at the lower edge of the expected move, so I don't think that it's time for new aggressive new money shorts. Instead, I would love to see this balance out sideways, put in some sort of acceptable bear flag, probably another day or two for that to sort of, quote unquote, hit acceptable in my book at least. And then maybe there's a breakdown here. A couple of things that I do like, and we talked about this in the pre-market live stream, is the fact that this low here had meaningful excess on our market profile. We'll get to that in just a moment, but I do like the fact that the Tuesday bar was a nice completion of the auction at the lows, essentially is what I'm getting at. It bounced perfectly off of our 371 that we identified as a high volume node on the weekly watch list video from Sunday. So overall, nice little potential for a bottom here, but the fact that the buyers didn't do their job again at the highs is the concern at this point in time. And of course, the fact that sectors are not confirming any sort of bullish look right now is also another cause for concern. So just to keep it very simple on today's session, into the remainder of the week, the only bullish trade is probably looking for the remainder of the gap to fill. Because it didn't happen once on the first go, that's usually the most important go, I'm not sure that I would carry it forward as like a very high probability setup into the remainder of the week. I think more balance could be in store here. And then shorts only underneath 371 if we take out this meaningful low to get into 364. And just to show you where that's coming from, we've got to go to a weekly time frame chart. And if we just look left over here, we had a resistance, 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 break, retest for support, 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 support. That's why we have 364 on our daily time frame as the next level of support down underneath us. So do be mindful of that. If we get continuation to the downside, we break down from this little balance that we're starting to put in, right? The bear flag breaks early. Again, I'm probably not overly keen on jumping into the short side here, maybe a quick scalp, but I don't think that it would be wise for new money shorts right now for anything that's a longer time horizon than just, exactly that, a day trade, a scalp. Let's take a quick peek at the 30-minute time frame just to see what else we might be able to learn about the market activity on today's session. I would say that this lower edge of the expected move, for all you like really nuanced short-term traders, 376 is a pivot into the remainder of the week. If we remain above, kind of more neutral for the possibility of the gap fill overhead, you can see again support, resistance, resistance, support all throughout the morning, right? And as we get the volatility, we close above that level. So 376, carry that forward as important, use it as a pivot. If we fall back down underneath, it definitely starts to get into the category of bear flag consolidation, expecting a breakdown after that, obviously, if we start to breach that 371 as we just mentioned. Let's take a quick peek at the market internals. So what do we have over here? I'll fire this up. I've got to switch the grid real quick. And by the way, as I sort of adjust this, I've got a video for you yet again in the top right-hand corner that describes what it is, how to set it up, all of that good stuff, how it'll help you make better intraday trading decisions. Zooming into the week's worth of internals so far, though, here we go. What do we see, right? The volume was really impressive to the downside on Monday. I mean, the breadth readings up here were at times north, or I suppose south, because it was technically negative, of 100 to 1 reads, which is something that you hardly ever see in the marketplace. So there were some serious outflows on the Monday session, which again is sort of aligning with the idea that the market's not really ready to just see a major snapback just yet. I think the outflows were serious enough to prevent the market from doing that, but I'm not sure I would be a new money short at this point of time. It's also aligning with the fact that the sectors still look like they're poised in a risk-off manner. Tuesday really balanced on the FOMC, just scratching at that positive 300 million plus mark that we're usually using as a significant read. Whenever you have FOMC, it's pretty tough to read into the internals there because of the amount of volatility that you've seen. So snapping back from oversold readings on the Monday session, again, that's fine there. That strikes me as healthy. This over here is not sustainable. And on today's read, notice that the cumulative build in the tick is essentially flat. On the quote-unquote rally that we saw on the FOMC, right, the tick didn't get positive really in any major sense at any point during the day. So again, not really very impressed by the activity out of the buyers at this point in time here. So that's the internals. Let's take a quick peek at the market profile. I'll show you that low that I was talking about here. Here we go. There it is. That's the SPY lower wick that I was just mentioning. Notice that there's good meaningful excess in that L period instead of ending on a poor low, which we actually have in the past, right? So I've got to quickly flip this contract over to the M. So if I go ESM, and I just quickly remind you of what we had from in the past. So I've really got to scrunch this thing up here so we can show that to you. Come on, ESM, is it not going to load the data? Oh, that's unfortunate. You can go back and watch either the pre-market live stream this morning, or you can go back and watch a midweek market update. But one of the prior lows way off to the left, the last time we made a new significant gap down low, we can find that on the SPY Daily in just a second, it put in a poor low. We do not have poor lows on the sessions on today's session or yesterday's session at the lows here. This, again, good meaningful excess at the lows. Look at the volume taper here. The other thing I would point out from the market profile perspective is that if you look at what happened with value today, so here's value on Tuesday, here is value on today's session, then it actually shifted higher, right? Point of control migrated higher with price as well. So that's, sort of counteracting what we just said about the buyers not really doing their job getting into the gap overhead, maybe we've got to give them a little bit of wiggle room here and say, okay, maybe if we consolidate above that pivot that we just identified in the SPY, that was at 376 level. In the ES, it would essentially be the 360. I would say it's probably, a more accurate level would be 37.75 rather. But nonetheless, if we stay above that, again, value did shift higher. Maybe we've just got to digest this a little bit and then the move can unfold. So decent evidence in the market profile that this is a better low than what we've seen in the past, and value is shifting higher. My major concern right now in this market is just that the sectors suffered so much damage over the sort of weekend and on the Monday gap down. So I don't want to sort of harp on that too much, but conflicting signals here with the ES futures in the market profile indicating more of a bullish look. So back on over to the platform to round out the broad market here. What do we see in the QQQ? I'm going to go back on over to the daily time frame. We'll take a quick zoom in over here. Notice that this did not fill the gap either. Let me quickly adjust it. Kind of annoying when we're in downtrends to have to adjust our charts so they're easier on the eyes, but partial gap fill, a little bit more meaningful than what we saw in the S&P 500. Yes, don't get me wrong. And we also closed right at the edge of the gap instead of back inside like the S&P 500. So I would use this as sort of an indication to say, if the QQQ can remain outside of the Monday high and do something like this, you should probably look for the ES to catch up a little bit. And maybe we get a little bit of a dead cat bounce in our sectors. Again, not a full-blown reversal, but a dead cat bounce, and there can be short-term lift into the remainder of the week. So use the QQQ as a relative strength gauge if it remains above Monday's high. If it falls back down into this range, again, that's more of that neutral and risk-off indication. We should probably watching for bearish digestion and then lower in the future here. Levels to be paying attention to, that Monday high, let's go ahead and map that out together, is going to be, if we quickly do a click here, around 282.25, we'll call it. And then any upside continuation, again, consolidation here, breaks, get us back into this range there. So above 286.88 can start to move into the bottom of our next overhead gap around 295. That's asking for a pretty large reversal here. And again, getting some pretty major continuation. I'm not sure that we're in store for that based on everything we've discussed so far in today's video. But again, just use Monday's high. That's going to be a major pivot point, I would imagine, into the remainder of the week. If we fall back down underneath, again, bearish consolidation, next target underneath 266.75 inside of the QQQ, coming from that weekly structure. I'm not going to zoom back out and find it for us. Next up, we've got IWM Russell 2000 and the small caps. What's going on in small cap land? Taking a quick peek. So certainly not as bullish as what we just saw in the Qs, more on par with what we saw in the SPY, even more bearish, I would say, than the SPY, which is interesting. Remember that this was showing the first, more significant signs of a new budding uptrend. So nonetheless, back down to relative weakness here, not signaling any sort of major risk on divergence. The trade to the upside is obviously looking for the gap to fill here because we did not get into it just yet. So any more interactions with that 174.75, look for that to break and start filling up towards 177.60. From there, I would watch for the gap fill reversal, especially if the rest of the broad market is rolling over as well and not really seeing follow through to the upside. And then your lows are going to be here at 169 to watch for a breakdown. That's underneath today's low. And then again, we would look for the move all the way to our next level of weekly support, which is around 164.20 inside of IWM. So currently bearish acceptance at the lows. I would just be patient. I would not want to get chopped around in this sort of area right here in IWM. Instead, wait for the gap fill overhead or a breakdown of that 169. That's been an in-depth look at our broad market. Let's quickly speed through these core list of companies, and I'll give you those 3 trade ideas towards the end here. Apple, what do we see? We did fill the gap, but again, we pulled back aggressively off it. Just like we talked about in the Qs, I would use Monday's high as a pivot point there, around 135.15. If we can remain above, strikes me as a more bullish implication. If we fall back down underneath, neutral to slightly bearish, looking at breakdowns of 132, noting that it's perfect 2-day lows here, just like we discussed in some of the sector charts. That's not a very strong area of support because we have the back-to-back lows. Quick stop run can happen underneath that and give us a further breakdown. Because we do have the lower low from here to here, certainly there's the possibility that even if we fill this gap, we are just forming nothing more than a lower high. So again, all the structural damage that was done out there on the Monday gap down, it's really across most things that we're really paying attention to. So immediately taking us from what initially started to look like green shoots back down to saying, okay, trend continuation to the downside is certainly in effect. Next up, we've got Netflix. What's going on in Netflix? Again, really massive move on today's session, up 7.53% from the open here. But where are we, right? Here was our prior uptrend. We're still underneath. We have not filled this gap overhead. Don't get me wrong, the chart does look a little bit more bullish than everything else, with the green close up higher in the upper third of the distribution as opposed to more towards the middle of the distribution. I would want to see at this point in time pullbacks that hold 176.44 to form something like an hourly bull flag, and then potentially looking for that gap to fill overhead as the next trade set up. So longs up and over today's high to potentially get into that gap overhead. That's 185.72 up towards 192.22. And then I wouldn't push my luck on the gap fill, noting that again, we could see a rollover here. Technically speaking, this could be an equal / very, very minutely higher low. I wouldn't really look into it that much. I wouldn't read into this as like a bullish sort of sign for Netflix. Nonetheless, just stick to that setup here, consolidation and potentially a break for the gap fill overhead. Anything that fails 176.44, look for lower into 169, we'll call it, just for round number's sake. That is, of course, today's low of day where the rally stemmed from. Next up, we've got Tesla. What's happening in Elon Musk land? Certainly, downtrends in effect, right? If you think about it like this in the short term, and again, let me just adjust this. Very annoying when these things are at the bottom of our screens. There we go. That's much better. So downtrends still in effect with lower highs and lower lows being confirmed on the Monday gap down. Keep in mind also, we have this failed inverted head and shoulders. The neckline was way up above at 780.75, and we're coming in for a back test of the breakdown of the right-hand shoulder. So 700, really, really important here inside of Tesla. If we, get back down underneath it, that to me is again, a lower high here, and we should be scouting for the move into the equal lows and 625. Remembering that this too is a poor area of support, could use some repair. I would expect a quick and snappy break underneath that if it gets reattempted off of, again, just trend continuation and a clear lower high off of 700. So Tesla, although yes, it did rally and it had a significant percentage basis move to the upside, structurally speaking, kind of still in the bear territory, right? The only thing that changes the trend, just like we were talking about in sectors, is a break, retest, and some sort of higher low above 700 at this point in time. Because we do have a bullish engulfer, or not engulfer, but solid-bodied candle on today's session, I would be willing to not just immediately look for the rollover here and say, okay, if it does want to do something like this, it'll start to change the trend. But again, probably watching for the higher low pullback above 700 when and if that happens in the first place. So yes, bullish momentum on today's session, but please, if you're looking for the long, be patient for that instead of just saying, okay, it's got to be a buy here, expecting that, because there's the possibility that we do that, right? The market's all about reading the play. Think of it like a game of chess, trying to stay one step ahead of the opponent. You don't want to sort of make a rookie mistake of, thinking that you're going to put him in checkmate and you've actually just lost your queen because you made a silly move, right? So that's a nice little analogy for you. AMD up next, currently in the low end of the balance, right? Certainly well underneath the 50% mark. The only long trade to be watching out for is the gap fill overhead, and I would not push your luck when that gap fills, noting the 50 SMA is going to meet us there for super resistance. Instead, bearish consolidation can happen here if we never get the break in the first place. Notice that we're already getting bearish acceptance at the lows with the indecision dojis inside of the Monday range, and then breakdowns will occur underneath 85. So just like everything else, bear flag can kind of happen in here, and then over time, looking for the breakdown of that 85. Do we have a support underneath? Yeah, way down there at 73. So if this happens into the remainder of the week, I would just trail a stop lower and lock in some profits. Meta up next for the old Facebook. This ticker change threw me for a loop at the end of last week, rather. Nonetheless, failure to fill the gap overhead, just like everything else we've discussed, a little bit of relative weakness with the indecision doji that printed today. It's not as strong as what we saw in Tesla or Netflix even. So to me, bearish consolidation happens down here, new significant lower low from here to here. There's a strong possibility that even if we do rally, and it could happen all the way up to 188.50, it just forms a lower high and keeps the downtrend in place. So, could there be some snapback? Yes, probably taking tight risk and watching for the gap fill trade here, 172.56 up to 175.02. That's probably a quick day trade. And then from there, trailing the stop higher if we move higher in the first place, but not, don't get your hopes up here for any major reversal inside of Facebook to the upside. Breakdowns, I probably would want to see it consolidate a little bit further before the breakdown, and then I would pay attention to 165.58 if I just go on over to a 30-minute time frame. The reason I call that number out is because, let me scrunch that up a little bit more. Look at this as a double bottom, right? Higher low double bottom. Technically, your neckline was here, and that's exactly where we held to the T on the FOMC sort of volatility, right? So 165.58. If it starts to break down, that's probably your advanced heads up warning that we're probably going to move lower and fail the double bottom in the first place. Next up, NVIDIA. What's going on here? Going on up to the daily time frame, zooming in. and adjusting the chart because, again, these things are hideous when we're in downtrends. There we go. That's a little bit better here. So currently at the low end of balance, here is the prior balance area. This did not make a new significant lower low here. If you do remember what we were talking about in the pre-market live stream on Tuesday, we were talking about be cautious of shorts here inside of NVIDIA. We could swoop underneath, collect some liquidity, and move higher. That's exactly what happened. So equal lows, kind of respecting the balance area that's in play. We're in the midpoint of the range. So whenever we're in midpoints of ranges, as you know, if you've been watching the channel for any period of time, you don't really have good risk reward here. So I think the play is patience inside of NVIDIA. If we roll over here for a lower high, then yes, on the second attempt, that's where you look for the short and the breakdown. And for longs, just being in the midpoint, filled the gap, pulled back a little bit. I'm not really seeing the clear entry here for a long yet inside of NVIDIA. It's probably got to prove itself, form a higher low inside of this range now that we've closed the gap, and then maybe we can shift our tone. But currently, I just think that unless you're looking at a 5-minute scalp pattern or a 15-minute bull flag, ascending triangle, whatever, there's nothing to really call out here from the daily time frame. Just looking like, again, if we remember back to our sectors, 100% retracement, dead cat bounce, boom, that's the more attractive short as of right now, and no clear indications for a long just yet. Microsoft up next. What do we see here on the daily time frame? I'm going to zoom in and then adjust our chart so it's a little more manageable. There we go. That's a pretty good system. Maybe I'll just continue to do that next week. What do we see here? So filled the gap, moved inside the prior day's range, and then closed right at the filling of the gap. So this is a little bit more strong, exhibiting a little bit more strength rather than what we've seen in some of the other charts, noting the close of the daily bar. It's firmly outside of the 2 days here and much closer to the gap close area, and we even explored inside of that range here. So nonetheless, I would watch this one for any higher lows at this point in time that hold above this 247, 50, coming from the 30-minute time frame. Again, think about where the important structure is, holding it as support on the opening range. FOMC volatility holds it as well. As long as we're above that, fine. Maybe this starts to form a bit of a higher low and starts stair-stepping in the upward direction. And then the next long entry would probably be okay. Actually, we'd probably have to scout that on the 30-minute time frame. If this turns into a bull flag, your break of 254 is the long, right? And boom, moving through this thin structure, because you're taking that out as well, and your target would be 261, right? So Microsoft, watching for a little bit of relative strength here. This chart probably looks the best in terms of the way that the bar closed. But again, let's just be mindful of trend analysis. Here we go. Lower low was put into place. So even if we do rally through that thin structure that we just identified, be mindful that we probably shouldn't push our luck, noting that the trend is still firmly down. Last but not least, the mini beast. We've got Amazon. What's happening here? Oops, I just said I was going to use the same process, so I'll zoom like this. I'll adjust like that and drag it over. Good. That's much better. There we go. So failure of the bull flag, we talked about 100% retracement, a little bit of a dead cat bounce, closed the gap, pulled back a little bit. Again, this to me strikes me as still just a dead cat bounce. Nothing about this says more meaningful reversal. We're going back to the highs here at 126. Not there yet, right? So watching an Amazon for anything that does this above sort of that FOMC low around 104.08 or 104.80, excuse me. You can see that just like we talked about inside of NVIDIA. Here's your sort of double bottom neckline, if you will, held it to the T on the FOMC volatility. If we remain above, neutral to bullish, watching for the next trade here. If we break down underneath, this is a major flush point with now 3 interactions. At 102.61, we would also have the lower high dead cat bounce. Boom, that leads to a breakdown to get you into roughly 97.62, which is a weekly level of support. So that's been the core list of companies. Thanks for sticking with me through it. Let's get you through these 3 trade ideas quickly. First one's on WMT for Walmart. The reason I like this chart is because we're starting to form double hammers. Again, let me actually use this method. There we go. So double hammers down at the low. So could this turn into a double bottom? Yes. Remember that would require taking out the neckline way up there. But if you're a really aggressive trader, right, double hammers, if you take out the highs here, you're probably looking for the rotation here, 124, these recent highs, with a stop under the lows, right? That's if you're a swing trader, then monitor for continuation into the neckline there. That would make sense from a risk reward. This compared to this. But if you're only looking for this, then you're probably using an intraday level or an intraday pattern to enter and then sort of manage your risk from that perspective. Or if you're intent on using the low here, that's fine. Just move your stop to break even as soon as possible. That way you have a risk-free trade and you can kind of monitor for that continuation. Nonetheless, really just liking the double hammers that have formed here at the equal low area of 118. Obviously, it's got to take out the highs for this to trigger as a trade. If we just remain sideways or break down, it's off our radar. That's Walmart. Next up, we've got MU for Micron. Going to be very similar in terms of the double hammer setup. Let me stick to my process. Here we go. So big range that we've fallen out of, absolutely falling off of a cliff here, going sideways, trying to find a little bit of a footing. Double hammer setup, again, high If that gets breached, you're looking for this to fill the gap into roughly 62. Monitor for continuation into the bottom end of balance here at 66. I would be really mindful that you probably shouldn't expect much more than 66, noting you have a ton of overhead supply, break, retest, then could potentially head back lower. But in the short term, the double hammer setup, the fact that we failed to materialize underneath the prior day's low, because technically we did make a new lower low, would indicate that the sellers are probably running out of bullets here at the lows. So monitor those highs for the gap fill is probably the short-term trade if that's what you want to watch. That's MU. And then the last one is going to be, let me look at my notes here, sorry, ZM. Zoom, can you imagine that? Coming back from the dead here. The reason that this made the cut is because look at what's happening inside of Zoom. Who would have thunk, right? Inverted head and shoulders, certainly something that looks like this, or you could just say bull flag. This clearly has, oops, not sure what happened there with the Zoom. But this clearly has a higher low already in place, higher high already in place. The trend is starting to change here inside of Zoom, and this breakout point is something we should watch around 115. The 50 SMA is starting to go sideways, turning into support here as well in the most recent bounce. So anything that remains in the flag consolidation strikes me as nice and healthy, and anything that breaks out up and over 115, look left, your target's here for a move into 126.62, about 11 points, right? So definitely worth watching here inside of Zoom, and if you remember range rules, that roughly coincides. It's a little bit higher for a range double. Of course, you don't want to see Zoom underneath this set of lows in here around 105 to remain bullish on this particular pattern. So that's what I've got for you in today's video. If you enjoyed the video or learned anything new on today's session, feel free to let me know down below in the comment section or by giving the video a thumbs up. Don't forget that the weekly watch list video will come out as scheduled, and we're also doing pre-market live streams daily starting at 8:30, so feel free to join us there. And with that being said, I wish you all a green trading week.